So yeah, I think if you look at it, it may sound expensive. It's $80. That means like almost a $25 billion market cap. It's 12 times revenues, but three times bookings. So Lyft grew revenues almost 60% in Q4 last year. So if you look at Lyft growing that fast this year and then slowing down to still very good growth at 30% next year, the company trades on 5-6 times revenues for 2020. So in order to make that price make sense, you need to believe in two things. The first one is that there is still some good growth. You have multiple years of a high double-digit growth for Lyft ahead of us. And the second thing, of course, you have to believe that Lyft gets to their 20% operating margin target. And so how do they get there? The road there is fairly straightforward. If you look at a Lyft driver, the contribution margin of his business to Lyft is in excess of 10% of total booking, which means almost 50% of Lyft's revenues. So the contribution of each driver is very profitable. In order to become profitable, Lyft needs to maintain their market share, keep growing revenue, and lower marketing expenses, lower the money they invest into hiring additional drivers, encouraging usage, and offering discounts to gain market share against Uber.
And they spent 37% of revenues in 2018 on marketing specifically, Pierre. And presumably, after the IPO, they could lift the gas off the pedal in terms of that marketing spend. But on the driver front, with such competition, with Uber wanting to keep its drivers, et cetera, I mean, can they continue to press the drivers to contribute, quote unquote, as much as they do to the company? Or will they have to start paying up? I mean, that's a major cost for any sort of asset-light transportation model. It's the driver cost. It's a labor cost.
Yes, absolutely. So two things. If you look at it like in the near term, over the next couple of years, the key is exactly what you mentioned, Melissa, which is how does the competitive balance stabilizes with Uber? So my big conviction on that market is that it's a natural duopoly. You have a first player coming in, grabbing land very fast and growing revenues very fast. And then that makes room for a second player who can be successful with drivers, upsets with the market leader, and who comes up as an alternative, a good alternative, like drivers and riders are happy to have two applications on their phone. And then there is no room for anybody else. And that becomes a duopoly, or all other players will be niche players. So in that duopoly, at some point, players will feel the market share split is the right one. And the day that happens, then you don't have to spend that much money on trying to hire additional driver. You don't have to spend that much money on discounts to increase the number of rides you're doing. So the key question for investors today is Lyft has pushed its market share to almost 40% in recent months. Is that sustainable? And in that case, Lyft is going to continue to grow and expand margins. Or actually, when marketing expenses are going to come down, will market share actually go down and stabilize at a lower level? Today, we are at roughly 60% Uber, 40% Lyft. That means Uber is 50% larger than Lyft. Is that the right competitive balance? Or actually, is the market going to go towards more like a 70-30 or 66-33% kind of balance? And in that case, Lyft will have to lose some market share when they stop spending. But the fact that they're going to stop spending in marketing at some point, to me, is a given. It's only two players in the market.